In this module, we are going to be covering the topic of bonds and specifically the terminology surrounding bonds. So first of all, as an overview, we're going to go through the concept of bonds. Bonds are a liability. They tend to be a long-term liability, and they can vary anywhere from 1 year, 5 years, 10 years, even longer than that. So we bring up the topic of bonds within that discussion of a long-term liability. Here we're going to cover, again, terminology and concepts specifically. Other modules where we cover this, we go through the journal entries and the bond pricing. So this module is specific to the terminology and concepts. So we're going to look at a few different concepts related to bonds, and in many cases we'll have where a bond can be either one thing or the other. So these terms are in direct opposition to one another. So the first two terms we want to create a distinction between are the face value and the issue price of the bond. The face value of the bond is what is in the bond contract, the bond indenture. The face value, it says that at maturity, this is what is going to be paid back. If you have a $1,000 bond, you're going to get $1,000 back at the end of that 1 year, 5 year, 10-year period, regardless of what you pay. So that's where the whole distinction between face value and issue price comes into play. The face value is the amount you will get back, even if you only paid $950 for it, or even if you paid $1,050 for it. If the bond is a $1,000 bond, that's what you'll get back. The other important role that face value plays is in calculating the interest payment to expect. Now, the interest payment in any bond, and we're talking the interest payment, not interest expense necessarily, but the interest payment is calculated by multiplying the face value of the bond by the stated interest rate. We'll talk about the interest rates a little bit later. So the issue price itself, this is how much was paid to buy that bond in the first place. Could be a $1,000 face value bond, but it could be sold for more or less than that. And again, in a little while, we'll see the difference between the two types of interest rates. The fact that they are different is what's going to lead to a different issue price. So just as a quick example, if your stated interest rate that you pay interest on is above the market rate, what that means is this bond is going to sell at a price higher than the face value. So the issue price might be $1,050, even though it's only a $1,000 bond, and you're only going to get $1,000 back when this bond matures. So again, the issue price is the amount paid by the investor to the company, and then down the road in 5 years or so, the face value will be paid back to the bondholder when it's paid off. So I mentioned we would talk about stated rate versus market rate. Now the important thing to understand here, this can get confusing if you do not understand this first of all. Different textbooks, different websites, different instructors may use different terms for these. There are 3 basic terms that mean the same thing. So we have these 2 different rates, but each of them has 3 different names to it. The stated rate is sometimes known as the contract rate or the coupon rate. So what we mean by the stated rate, this is stated in the contract that this is how much interest we are going to pay the bondholder. The term coupon rate is a little interesting, and it actually is a throwback to old bonds. When they use the term coupon, what this means is bonds historically used to actually have coupons on them. They used to be a piece of paper. They'd have coupons on them, and you'd clip the coupons and send them in or take them in to get your interest. They'd have so many coupons on it, indicating how many interest payments you're expected to get, and at each quarter, each year, you'd clip one off, take it in, and get your interest payment. So that's where the term coupon rate comes from. Now this is the actual interest rate paid to the company, or paid by the company, and And again, you have to multiply this by the face value to determine how much interest you're actually going to get that period. The market rate, on the other hand, is sometimes referred to as the effective rate or the yield. So this is the average rate for this risk classification of bonds that's paid in the open market. It's the average rate. And again, you compare these two to determine what your price is going to be. Now that's covered in much more depth in a separate module. If these two rates are the same, then that means the price of the bond is going to equal the face value of the bond, but these two rates tend not to be the same. And by the way, that's due to timing. Again, that's covered in a separate module. We dig in a little bit further here with the terms discount and premium. So a discount bond means that the price of the bond, the selling price, is less than the face value of the bond. This means, in my example earlier, you're only paying $950 for a bond that has a face value of $1,000. Now, the reason for this is that the contract rate, that stated rate, that coupon rate, whatever you want to call it, the rate that this bond pays interest at is less than the average market rate. In other words, if we buy this bond, we're not going to get as much interest as we could if we were to buy a different bond. So it's not really as great of a deal. So we're going to be able to get a discount on it. We have to pay less. Again, that lower payment is to account for the less interest that we get along the way compared with an average bond. A premium is the exact opposite. The selling price is more than the face value of the bond. You may pay $1,050 for the bond today, but you're only going to get $1,000 back in 5 years. This is when the contract rate is more than the market rate. We are paying more with this bond than other companies are paying for their bonds. So it's a good deal. You have to pay more for it. You get more interest. A couple of additional terms we need to know. Debenture bonds versus mortgage bonds or secured bonds. When we talk about a debenture bond, this is unsecured. There's no collateral behind this bond. It's based on the good faith and credit of the company. Now, what that means is if the company defaults, there's no specific asset that's supposed to cover it. We'll get a place, if it goes to bankruptcy court, we'll get a place along any other unsecured creditor, which possibly means we won't get our full money back. We may not get anything if there's not enough remaining assets left over, versus mortgage bonds. A mortgage bond, and we can just call this a secured bond or a collateral bond. This means there is some sort of asset tied to this particular bond. And if the company fails to pay that bond off, they forfeit that specific asset. So they would be forced to sell it, forced to give it up, whatever the case may be. Let's talk about term bonds versus serial bonds. So a term bond means that this issuance of bonds, they all have the same maturity period. They could be all 1-year bonds. They may all be 5-year bonds, 10-year bonds, whatever. But they're all the same period of time. The lump sum is due at the end of the period, like with any bond. You'll get interest payments along the way, but the principal will be paid back at the very end. Unlike many loans that you may be familiar with where your payment is a little bit of principal, a little bit of interest, a bond, specifically a term bond, the only payments you get along the way are interest, and you're getting the principal back at the very end. Now let's talk about serial bonds. Serial bonds, the term serial means there is a series of bonds. So these bond issuances have different maturity periods. The first bond would be generally due in 1 year. The second bond is due in 2 years. Third bond is due in 3 years. So what it ends up looking like is an installment type loan. It looks like you're getting out of one huge bond. It looks like you're getting some of the principal back after year 1, some back after year 2, some back after year 3. But that's not actually what's happening. They're paying off each of the different bonds over time. So that's what a serial bond is. Now, this is one of my favorite set of terms here. Registered bonds versus bearer bonds. A registered bond, this means that the owner is always registered. So the company, whoever issued the bonds, always knows who owns this bond, who is entitled to the interest. If you sell a bond, that has to be tracked, so you always will know who the owner of that bond is. That's the common type of bond nowadays. Bearer bonds, some old, crime type movies, a lot of times, when they talk about what the crime is, somebody stole bearer bonds. So they're trying to track down the bearer bonds. I can't think of any exact titles right now, but I know I've seen some movies in the past. And, it was even before I knew what exactly a bearer bond was. But what a bearer bond is, it means that whoever bears that bond, whoever physically has it in their custody, owns the bond, and they will receive interest for it. Now, this ties back to that whole coupon that I mentioned earlier. A bearer bond will have the coupons attached to it. You have to clip the coupon to get the interest. The problem with these bonds is that they're very similar to cash. Whoever physically has it gets the interest, gets the maturity amount back, so they could be easily stolen just like cash. Much harder to trace. Now, because of this reason, that whole risk of theft, there's a concern with tax evasion, people transferring money back and forth without it being tracked, other illicit activities like drugs, just basically basic crime. Because of all these issues, bearer bonds have not been allowed for new issuances in the U.S. since 1982. Now, other countries still use these. It's not illegal overall. It's just that the U.S. doesn't allow U.S. companies, or certainly the U.S. government, to issue brand new bearer bonds. Now, there are still some bonds that were issued before 82 that are still out there. Some of these bonds have 50 years, 100-year maturity periods. So this doesn't mean they don't exist anymore. It just means that you can't have any new issuances. The bond indenture is the contract. I mentioned this term earlier. The bond indenture is just the bond contract that details all the legal requirements of the bond. For example, how frequently interest is paid, what the stated interest rate is, what's the face value, what's the maturity date. Another term we need to talk about is the callable bond. This is a bond that can be called back by the company that issued it in the first place. They basically notify whoever owns it right now, and they say, hey, we're going to pay this bond off early. Here's your money. Thank you. We're done. It's early payoff, early retirement. Now, the problem with this, the bondholder's not losing their investment. They're getting their money back. But the problem is, the only reason that a company would generally do this, the main reason, is that interest rates have dropped. So let's say this was a 10% bond. This bondholder was getting 10% interest, but now all of a sudden interest rates have dropped to 5%. The company no longer wants to pay 10% when they can refinance a brand new bond for 5%. The problem from the bondholder's perspective is that now they lose out on this great investment. Now they get their money back, but now they have to go invest it in a lower rate somewhere. Because of this, to offer a little bit of incentive or a little bit of extra for the bondholder that has to give their investment up now, there's a call premium. It's usually a stated percentage rate or a stated fee that if the bond issuer, the company, if they decide to buy this off early, not only do they have to pay you the face value of the bond, they also have to pay you a certain premium amount, just to give you a little bit of extra money for your inconvenience, so to speak. Now, the fact that these callable bonds exist gives rise to gain and loss on retirement issues that will be covered in more detail in later modules. Convertible bond. This example is where, similar to the callable bond, it's an extra preference, but this particular preference is for the bondholder themselves. They have the right at any point in time to convert that bond to a specified number of common shares of stock. So instead of being a creditor to the company, a bondholder, now you become part owner. It's at the demand of the bondholder themselves. This conversion privilege adds a little bit of value to that bond and basically allows the bondholder to trade the fixed reward. In other words, relatively low risk, fixed interest rate. You're trading that to add a little bit of risk. You know, as an owner, as a stockholder, there's a risk that you will not receive a dividend at all. But there's also the possible reward that you may get a higher amount of dividends than you would have for interest for bonds. So that takes us through what we wanted to discuss for this section. We will be covering more topics in later modules.